This report argues that the global financial system is at a critical turning point on December 10, 2025, with markets split between optimism about a soft landing and deep concern over inflation, fiscal deficits, and policy mistakes. The focal point is today's Federal Reserve meeting, where markets expect a 25 basis point rate cut to a 3 points from 3.75% federal funds range, the third consecutive cut. Futures markets assign roughly an 87-90% probability to this move. Superficially, that looks like a standard easing cycle after winning against inflation. But the report stresses that the context is very different now. Inflation risks remain, data quality has been impaired by a long U.S. government shutdown, and financial markets are sending conflicting signals. The concept of a hawkish cut is central. The Fed is expected to cut rates, but might project fewer cuts or even a pause in 2026 in its interest rate projections. Markets are currently pricing about 2 more cuts in 2026, but recent data may push the Fed to signal a slower path. The situation is complicated by the 43-day government shutdown that ended November 12th, which delayed key inflation and employment data releases. As a result, the Fed is flying blind, relying more heavily on lagging indicators and private data. That raises the chance of a policy error. If the Fed cuts into an inflation reacceleration driven by tariffs and wage pressures, it could unanchor inflation expectations. If it tightens or pauses too soon on the basis of incomplete data, it could worsen labor market weakness. Despite this uncertainty, the Fed's internal plumbing looks stable. The discount window primary credit rate is 4.0%, and there have been no unusual spikes in discount window borrowing over the last 24 hours. That suggests no acute banking sector liquidity problem, giving the Fed room to take a tougher rhetorical stance without triggering immediate financial instability. Monetary policy abroad adds another layer. The Bank of Canada is also meeting today and has already cut more aggressively, with its overnight rate at 2.25% as of October 2025. Because Canada's economy is highly interest rate sensitive, due in part to short-term mortgage structures, the gap between the Fed's higher rate and the Bank of Canada's lower rate is pressuring the US dollar-Canadian dollar exchange rate. Markets expect the Bank of Canada either to hold or cut by another 25 basis points. If Canada cuts while the Fed holds, the US-Canada rate gap widens, strengthening the US dollar. If both cut, the spread is sustained. In any case, this policy divergence underpins a bullish case for being long the US dollar against the Canadian dollar. In Europe, the European Central Bank has already executed 2 sizable 50 basis point cuts to support a stagnating Eurozone, but its tone has recently turned more hawkish as inflation is now roughly on target, suggesting further cuts are no longer automatic. The Bank of England, not meeting today, has followed a stop-start pattern, cut, pause, cut, because of stubborn wage growth, and is expected to consider another cut soon to support a weak UK economy. Japan remains the outlier among major central banks. While others are cutting, the Bank of Japan is hiking and has raised rates to 0.25%. The US dollar-yen pair has risen as US yields climb, but the risk of another Bank of Japan hike or direct currency intervention looms. A hawkish surprise from Japan could abruptly unwind the popular carry trade in which investors borrow cheap yen to buy higher-yielding global assets, potentially sparking a sudden liquidity shock in global equities. The report emphasizes a particularly unusual move in the U.S. Treasury market. Normally, when a central bank cuts rates, yields fall across the curve. Instead, the 10-year U.S. Treasury yield has risen toward 4.20%. This bear steepening pattern, long-term yields rising more than short-term yields, signals that investors want a higher premium to hold long-term U.S. debt. This reflects fears that Fed cuts could reignite inflation, a reflation risk, and that persistent large fiscal deficits will force heavy long-term debt issuance that could swamp demand, a supply risk. A close look at a recent Treasury auction helps interpret what's happening. The U.S. Treasury just auctioned $58 billion of 3-year notes with very strong results. The high yield of 3.614% was slightly below the when-issued yield, a good sign. The bid-to-cover ratio was a robust 2.85 times, up from 2.66, and foreign official buyers, indirect bidders, took 62.5% of the issue, showing strong global central bank demand at the front end of the curve. Direct domestic bidders took 24.5%, and dealers were left with only 13.1%, indicating little excess supply. This suggests the market is comfortable with the short-term rate outlook and broadly accepts the Fed's recent and expected cuts. By contrast, the rise in the 10-year yield shows deep caution about the long-run fiscal and inflation trajectory. The 10-year auction, scheduled for 1 p.m. Eastern Time today, is framed as a critical test. If that auction clears at a yield higher than prevailing market levels, it would indicate that investors are pushing back against the long-term fiscal story, what used to be called bond vigilantes, and that would be negative for risk assets like equities. Rising U.S. yields are also exporting tighter financial conditions abroad. German 10-year government bond yields have jumped to highs not seen since March, tracking the U.S. move. In Australia, the 2-year yield has climbed by 10 basis points to 4.07%, reflecting the Reserve Bank of Australia's refusal to cut rates, while domestic inflation remains elevated. This global move higher in yields naturally limits how far stock valuations can stretch, even where earnings look resilient, effectively capping upside for the S&P 500. The report then turns to U.S. liquidity conditions, where it sees a striking split. On one side, there is a record wall of cash parked in money market funds, totaling $7.65 trillion, up nearly $87 billion in the most recent week. Institutional money is about $4.60 trillion and retail money about $3.05 trillion. In a world of relatively high short-term rates, those funds earn around 4% or more, so many investors are content to sit in cash-like instruments rather than move into riskier assets. But as the Fed cuts rates, yields on money funds will fall. The key question for 2026 is what happens to that $7.65 trillion cash hoard. If it flows into equities and other risk assets, it could fuel a powerful melt-up. If it remains in cash despite lower yields, it would signal enduring pessimism about the economic outlook. At the same time, usage of the Fed's overnight reverse repurchase, RRP facility, has collapsed to just about $3.2 billion, after being a major tool for parking excess liquidity. Money funds now increasingly place cash into private repo markets and treasury bills instead, consistent with strong front-end treasury demand. The near-empty RRP facility means one of the system's key buffers for absorbing excess reserves is gone. Any further Fed balance sheet reduction or quantitative tightening now drains reserves directly from the banking system instead of being cushioned by RRP usage. That raises the risk of a sudden spike in repo market funding costs, reminiscent of 2019's funding stress. The report argues that this may force the Fed to halt quantitative tightening sooner than previously expected to avoid a damaging plumbing accident. Alongside this liquidity story, the money supply is quietly re-accelerating. The broad M2 measure has resumed growth, reaching $22.30 trillion in October 2025, with month-over-month growth of about 0.39% and year-over-year growth of around 4.65%. After contractions in 2023 and 2024, this renewed expansion supports the idea of a soft landing, but also validates the concern about sticky inflation. More money in the system fuels nominal GDP growth, making it harder to sustainably pull inflation all the way back to the strict 2% target. A key piece of delayed labor market data, the October Job Openings and Labor Turnover Survey, has just been released. It shows job openings rising to 7.67 million, well above expectations of 7.2 million, while hires are flat at 5.1 million. The quits rate is low at 1.8%, equal to 2.9 million people voluntarily leaving jobs, and layoffs are steady at 1.9 million. The report highlights the contrast between high job openings, which show firms still want to hire, especially in more defensive areas like healthcare and government, and low quits, which reveal workers are cautious and afraid to change jobs. Firms' ongoing demand for workers contradicts the idea that a recession is imminent, but the low quits rate confirms workers perceive the market as cooler and riskier. For the Fed, the absolute level of openings, 7.67 million, is still too high, implying that wage pressures could reignite. The vacancies to unemployed ratio remains elevated, reinforcing the hawkish cut concern since the Fed cannot credibly claim the labor market is fully rebalanced. Equity markets reflect these cross currents. While headline indices like the S&P 500 and NASDAQ 100 have largely moved sideways into the Fed decision, under the surface there is a sharp rotation. The Russell 2000 Small Cap Index is outperforming and hitting intraday highs. Small cap companies typically have more floating rate debt than mega-cap tech giants, so they benefit directly from rate cuts through lower interest expense and higher earnings. Institutional investors appear to be rotating capital out of overcrowded large-cap technology names and into smaller, more domestic and industrial names, aligning with a bet on a deregulation and lower rates-driven U.S. domestic growth rebound. Options markets reveal a different, more cautious story. Large sweep orders, designed to execute big trades quietly across many exchanges, have been hitting put options on the S&P 500 ETF at very low strikes. $620 for July 2025 and $560 for December 2025. These deep out-of-the-money puts represent institutional crash protection 6 to 12 months out, reflecting hedging against a potential recession or major policy mistake in late 2025 or 2026. There has also been intense put buying in Tesla options, with a $260 strike expiring December 26, 2025, where volume has soared to nearly 290 times open interest. That indicates a very focused bearish short-term bet, perhaps anticipating weak delivery numbers or a broader tech sector retrenchment. Meanwhile, traders are setting up a strangle position, owning both calls and puts, in Lyft around its rollout of autonomous services with Waymo, essentially betting on big volatility in either direction rather than a specific outcome. Heavy put buying in a high-yield corporate bond ETF shows credit investors bracing for a widening of credit spreads. If the soft landing narrative breaks, high yield or junk, bonds are expected to be hit hardest. Regulatory changes are adding another structural element to the picture. In a surprise move, the U.S. Securities and Exchange Commission has agreed to ease old restrictions on bank research analysts, loosening parts of the global research settlement. This allows more coordination between investment banking and research functions. That could make capital raising more efficient, but it also revives worries about pay-to-play behavior, where favorable analyst coverage is used to win banking mandates. The report suggests investors should become more skeptical of analyst rating changes for banking clients, as conflicts of interest may be on the rise again. The corporate news flow underscores that deal-making and financial engineering remain important drivers of value. Teleflex shares have jumped about 9% after it announced the sale of its original equipment manufacturer and acute care units for over $1.5 billion, with proceeds earmarked for share buybacks. This reflects ongoing use of mergers, acquisitions, and divestitures to unlock shareholder value. Alexander & Baldwin has agreed to be taken private at $21.20 per share, a 38% premium, confirming that private equity still sees opportunity in real estate. FirstEnergy has issued its 2026 financial outlook and reaffirmed a 5-year growth plan, an important signal in the utilities sector, which often trades like a bond proxy and is sensitive to rate and growth expectations. The most dramatic move in global markets is in silver. Silver has broken above $60 per ounce and is up about 102% in 2025, far outpacing gold, which is holding near $4,200. The report argues that silver is being hit by a dual squeeze. On the industrial side, demand from solar panels and electronics is outrunning supply. On the monetary side, investors are fleeing fiat currencies and seeking hard assets as protection against inflation and currency debasement. The compression of the gold to silver ratio, silver outperforming gold, is described as a classic hallmark of an inflationary breakout. In this framework, silver is a high beta version of gold, more volatile, but more explosive in an inflationary hard asset re-rating regime. Oil markets are more balanced. West Texas Intermediate crude has rebounded to around $60 per barrel. Prices are supported by ongoing conflict between Russia and Ukraine and the absence of a durable ceasefire, despite some political rhetoric suggesting progress. However, expectations of a supply surplus in 2026 cap the upside. So energy prices feed into the inflation and geopolitical risk narrative, but without the runaway spike seen in silver. Geopolitics enter again through a new U.S. national security strategy, which includes harsh criticism of European regulatory policies. This language echoes long-standing complaints from American executives and raises the risk of trade tensions and tariffs between the U.S. and European Union in 2026. That would be particularly negative for European exporters such as German automakers and luxury brands, and helps explain the cautious tone in European equity markets. Meanwhile, on the Russia-Ukraine front, negotiations are described as ongoing but stalled. Ukraine refuses to concede territory, and Russia shows no sign of softening its stance. This entrenched fog of war keeps a geopolitical risk premium embedded in energy and defense stocks. Bringing all of this together, the report frames today's Fed decision in terms of two broad scenarios. Markets are mostly positioned for a dovish cut, in which the Fed trims rates by 25 basis points and signals a path of continued easing. That outcome would likely spark a broad rally in risk assets, with small-cap stocks and silver leading. The key risk is a hawkish cut, a 25 basis point reduction accompanied by projections that show fewer cuts, or even a pause in 2026. In that case, the immediate reaction would probably be higher yields, falling stock prices, and a stronger U.S. dollar. Given the heavy institutional hedging in S&P 500 options and volatility instruments, the report argues that prudent portfolio managers should consider similar protections, such as buying S&P 500 ETF puts dated around June 2025, or call options on the volatility index, to guard against a Fed policy error that might force a painful reversal in 2026 if inflation flares back up. The conclusion is that the December 10, 2025 Federal Open Market Committee meeting is a watershed. The easy phase of the disinflation trade is over. Markets are entering a more complicated environment where chronic fiscal deficits, fiscal dominance, increasingly collide with monetary tightening. The bear steepening of the Treasury curve and the explosive surge in silver are framed as the market's verdict that inflation volatility is not going away. Investors, the report suggests, should look beyond the immediate rate cut and fix their attention on what the Fed is signaling for 2026. If the Fed quietly accepts somewhat higher inflation to support growth, that likely favors equities and commodities while hurting long-duration bonds. If instead it insists on bringing inflation all the way back to 2% no matter the cost, that stance would eventually benefit bonds but be harsh for stocks and cyclical assets. For now, capital flows into small-cap equities and real assets like silver indicate that sophisticated investors are leaning toward the first scenario, a reflationary soft landing in which hard assets and domestically focused companies are the main winners.